Yeah, hello everyone. Today we take a look at the accounting mismatch, which is pretty simple and straightforward, right? Um, so accounting mismatch is just a way where there is a kind of recognition inconsistency between two items that are economically related. Where two items are economically related, right? The way the items are treated must be in the same way, right? If an asset and a liability has a relationship between them, that is, they have something that is connecting to both of them. In that case, there is an economic relationship between them. The way the assets will be treated must be in the same way the liability must be treated. If the asset is treated or measured in a particular way, and its related liability is measured or treated in different way, that is an accounting mismatch, and it should be avoided, right? So example of what I can use is where, let's say, for instance, an entity takes a loan from bank and use that proceed from that loan to acquire an investment property, right? So it then means that there is an economic relationship between the investment property and the loan taken from bank, and that loan in this case, it is a financial liability, right? So the investment property will be treated in line with the provision of IAS 14, while the loan, which is a financial liability, will be treated in line with the provision of IFRS 9 on financial instruments, recognition, and measurement, right? So, in line with IAS 40, an investment property are initially measured at cost. Then subsequently, the entity can either use the cost model or fair value model. Then let's go to IFRS 9, which is a financial liability. In this case, for a loan, that loan will be initially measured at fair value, right? Subsequently, it will be measured at amortized cost. So let's look at the subsequent measurement of both the asset and liability, that is the investment property and the loan in this case, right? Let's assume that the entity has decided to measure the investment property at fair value model, right? And as you all know, the subsequent measurement of a financial liability, the loan in this case, is at amortized cost, right? If the entity should go by this way, it means that accounting mismatch will arise between the investment property and the loan. And this can be avoided, right? What the entity need to do is to decide to measure the loan at fair value to profit or loss and not at amortized cost. By so doing, the investment property and the loan are being measured in the same way. That is, the investment property being measured at fair value, while the loan, that is the financial liability in this case, is being measured at fair value to profit or loss. So it means that they have the economic relationship and they are being measured in the same way. So that is on the accounting mismatch. I hope that is clear enough. If you have any questions, you can put it on the comment sections. I will respond to that. Yeah, thank you very much.